A while back, I was doing some research for another project when I stumbled on some data from Vanguard that I found particularly interesting. Now, the data illustrated the historic returns based on asset allocation all the way back to 1926. Now, thankfully, there's also a graph that illustrated this data, and it shows what a portfolio with a given ratio of stocks to bonds should expect to see in returns over time. The graph also shows the top and bottom returns for the best and worst years in that span, again going all the way back to 1926. Now, the reason this information is so useful is because it illustrates just how portfolios have done for given asset allocations over extended periods of time. And because so much attention is given to asset allocation, that's the ratio of stocks to bonds that you have in your portfolio, this is really good data for us to make solid decisions on how to arrange our portfolios going forward. Again, there's no guarantee that the history of a portfolio will produce similar results in the future, but it does give you an idea of kind of how things transition or change based on the ratio of stocks to bonds you have in your portfolio. And based on all that, I made 4 observations about this chart, which I want to share with you now. The first one is very obvious. Stocks provide higher returns and higher volatility. As you might expect, portfolios that have a higher allocation of bonds tend to see lower returns, but also provide lower downside risk that these portfolios will dip significantly in value in any one year. Conversely, portfolios full of stocks have higher potential for gains, but present the trade-off of higher volatility from year to year. This is a perfect example of how rates of return tend to follow risk. The higher the degree of risk, the more investors expect to be compensated for that, and vice versa. I do want to be clear, however, that just because an investment is in a bond, that doesn't mean it's low risk. After all, the financial crisis back in 2008 was primarily initiated by the collapse of mortgage-backed securities, which were graded inaccurately. No, mortgage-backed securities are technically not bonds, but it looks like a duck, acts like a duck, so it's basically a duck. The truth is there's a broad range in the quality of bonds, and the value of a bond is dependent on the creditworthiness of the bond issuer. Standard & Poor's, Moody's, and Fitch Ratings are the 3 primary bond rating agencies. Naturally, it would be too convenient for them to have a standardized grading system, but generally bonds are rated on a letter scale like the grades you got when you were in school. A is good, D is not. If you see a combination of the same letter, it typically means it's a higher grade bond, so like a AAA would be like an A+. It's better than an A or an A- or an A or a AA. At the bottom of the heap are the appropriately named junk bonds, which carry the highest degree of risk because the issuers of those bonds are not considered to be on the strongest financial footing. If a bond issuer goes into default, the bonds are almost completely useless. Bondholders are relatively high in the pecking order for compensation from the liquidation of a company's assets in bankruptcy, but that's really not anything to be excited about. For the most part, individual investors will elect to buy bonds via bond mutual fund or ETF, which will hold a wide variety of bonds issued by institutions with varying degrees of risk. So in summary, a well-diversified basket of bonds is certainly less volatile than stocks, and overall it will almost certainly be less risky too. And the chart seems to bear that out. Observation number 2 is the happy middle ground. Now, we just discussed how the expected returns of an investment are correlated to the level of risk intrinsic to that investment. In fact, if you look at the average returns on the chart, they follow a near linear path with a shift from a bond-heavy to stock-heavy portfolio. Just look at the average return difference between the 0-100 portfolio, that's 0 stocks, 100% bonds, and the 100% stock, 0% bond portfolio. The 100% stock portfolio earns exactly twice the average return. That's 10.2% versus 5.1%. It's interesting to me, though, that the range of volatility, while somewhat predictable, doesn't follow a linear path like returns. It looks more like a funnel. Now, just based on the appearance of the graphic alone, we can tell that there's a loss of correlation between the 2 sets of data. In this case, at a certain asset allocation, the level of volatility doesn't increase the same rate that the average returns do. That means we can get more return without adding an incrementally equivalent amount of volatility, which is a component of risk. For example, by moving from a 100% bond asset allocation to a 30-70 stock to bond allocation, you get exposure to a higher average return, that's 7% versus 5.1%, without a proportional amount of additional downside risk. It's negative 15 versus negative 13, so just negative 2% more risk for 2% more return. 2% higher annual returns for a less than 2% chance you'll experience a slightly worse performing year in 1 year out of the many years you hold the portfolio is a really good trade. Now, this doesn't necessarily mean that you should hold a 30-70 portfolio, but the data does seem to indicate that there's a better balance between risk and reward than those in a 100% bond portfolio. Hey, if you're finding the information in this video helpful or useful, please consider clicking like and subscribe below. That'll help our channel to grow. It actually allows me to continue making videos like this so I can teach people about personal finance. The third observation is misleading averages. The impact of the average returns is easy to misjudge if you don't understand compounding interest. On average, the returns on portfolios heavily tilted toward stocks may appear to produce an unimpressive difference. So little, in fact, that you might even think the downside risk isn't worth the potential upside gain. In actuality, the cost of double the return between the 100% bond portfolio and the 100% stock portfolio, that's 10.2% versus 5.1%, is 4.14 times the end value in compounding interest over the course of 30 years, 6.67 times the value in 40 years, and 10.7 times the value in 50 years. That's not so unimpressive. The truth is, even the smallest differences in the rate of return can grow to significant sums over time. Do your best not to give up ground here if you can help it. If you have longer to invest, you're taking a lot of risk by not using stocks. The fourth observation is not to let the range fool you. If you look at the growing span of ranges between the highest and lowest performing years, you might be tempted to assume that a 100% stock portfolio is 3 times as dangerous as a 100% bond portfolio because the stocks lost just over 3 times the amount of a bond portfolio in their worst year. And that would be an incorrect assumption. Once again, the truth is the range in this chart is misleading because each value that we see from the range is based on a single year, while the average returns are based on 96 years. There's no question that in their worst years, stocks are much uglier than bonds. However, the inverse is also true. The pretty years for stocks are far more exciting than the best years bonds will ever produce. Now, what we really need to see to understand the true downside risk of stocks and bonds is the performance of a variety of portfolios over time, not just data from a single point in history. Now, with that in mind, I give you this lovely graph from portfoliocharts.com. You may have seen this in other videos we've done. What you're seeing is the performance of 3 hypothetical portfolios. In red are portfolios that contain 100% stocks. 60-40 stocks to bond ratio is represented in aqua, and something called the coward's portfolio, which I won't bother describing here because it's irrelevant to this post, is represented in gold. Now, each portfolio represents a series of 44 investors who invested $10,000 each year from 1972 to 2015. The only difference is they each started in a different year. Now, clearly, the 100% stock portfolios experience the highest degree of volatility. The range from the peaks to the valleys is definitely the largest. But what's most interesting to me about this graph is the fact that the bottom of the 100% stock curve, the one in red, isn't much lower than that of the 60 portfolio stock to bond portfolio, and it even stays above it completely beginning in year 27. In other words, over time, the downside risk of stocks has been overcome by the upside potential they produce in returns, historically speaking. That's all the upside without the downside, simply by holding the investment for a long period of time. The natural conclusion is if you have enough time, there's little reason to select bonds over stocks. And that's why I tend to harp on asset allocation that matches the timing of your needs with investment as opposed to an allocation tied up to your perceived investment risk tolerance. For monetary needs within the next 2 years, store your money as cash or cash equivalents in savings accounts or money market funds. For needs that are 2 to 5 years down the road, bonds provide a comfortable mix of stability and returns that are normally better than what you'll see in a high yield savings or money market account, though 2024 has been a bit of an exception. For needs that are 5 or more years down the road, stocks bring the best returns, and since you'll be holding them for at least 5 years, you'll have time to ride out market volatility. Of course, a market portfolio invested heavily in stocks is not for the faint of heart. If market volatility will drive you to make drastic changes to your portfolio out of fear, then you should probably be invested conservatively enough to avoid doing that. Really, if you sell out of fear, it basically serves as sequence of returns risk, because you probably will do that at the worst possible time when things look bad, which is exactly what sequence of returns risk is. So there you have it. If nothing else, I think this information is super valuable for you if you already have a selected asset allocation for driving sort of your expectations in terms of returns and volatility over time. If there's anything about this chart that you saw that I didn't talk about, please talk about it in the comments below. I'd love to hear and see what you have to say about it. As always, we are grateful for your interest in our videos. God bless and take care.